So we move to Chapter 10, Alternative Cost Accounting Methods. And I do find this particular chapter and these areas fairly interesting and a little bit easier to perhaps master than the traditional methods of costing that we've discussed, i.e. marginal and indeed absorption costing, because broadly speaking, there's no real calculations or no heavy-duty calculations. They're fairly straightforward narrative style areas. Let me explain what I mean. I also think that the questions are much more straightforward. So this first area of an alternative method to cost units or cost of product, ABC, activity-based costing. Okay, now let's look at the definition first. So what we mean is it's a form of absorption costing, but certainly not as complex, where overheads are absorbed into products based on a wide range of activities involved in producing a product or service. Now, that's a lot of information. Let's break this down a little bit. Really, what we're saying there is if we consider back to absorption costing and indeed marginal costing, really, they're what would be known, as we said when we walked through them, as being sort of traditional approaches. They've been around for years and years and years. And in particular, when we think of absorption costing, I mean, clearly, when we're looking to absorb sort of overheads into, let's say, units of production or into a product, we're making the assumption that obviously, direct costs, i.e. other costs, e.g. labor, etc., are already absorbed. In other words, it's easy to calculate, well, there were 5 hours of labor, there was 20 kg of material, etc. Now, that's fair enough, but let's look at how manufacturing and indeed technology, automation has changed over the course of time. In other words, let's look at how, let's say a given product is manufactured today as opposed to 50 years ago. And my point is this, is that, business has changed, manufacturing has changed, and indeed, to a large extent, perhaps more fixed overheads have become more relevant, and labor and direct costs less relevant. So the idea that we could simply say, well, it's 5 labor hours and 20 kg of material and, limited fixed overhead, that doesn't really wash anymore, okay? Now, I'll open that up a little bit more as we go through this particular branch, but in essence, what we're saying is that ABC, activity-based costing, focuses in on the different activities that may drive costs, as opposed to one man with a set of hands, i.e. labor, as opposed to 20 kg of material, i.e. materials. So maybe if we use this form, we may get to a more accurate cost. That's the issue. So outside of that, the main principle is really that activities cause or drive costs, okay? And given that, and indeed subject to that, let's trace costs to activities and then to products rather than costs directly to products, okay? Now, 3 main steps, and I think we need to know these steps and we need to be familiar with the little buzzwords. The first one is reasonably simple. Let's identify what we would refer to as cost pools. Where are we incurring costs? There must be a series of pools where we can see costs building up, whatever they are, okay? Given the cost pools, let's try and figure out what drives those costs to that pool or to those pools. And if we can establish that, let's calculate, given point 1 and indeed point 2, let's calculate a cost per cost driver. Okay, let's calculate or establish what is it that is in effect driving those activities and driving those costs up. Okay, so that's really the sort of the essence of it in terms of ABC. And that's all we need to know. In terms of target costing, unusual approach here, because target costing really turns costing, as it were, on its head. Sort of turns it inside out. Let me explain what I mean. I know that you've been through the chapter, so you should have a reasonable fix on this. Really what we're saying is, in simple terms, it's a way of really working out a target cost. What it suggests here is, maximum cost of a product can still incur and still expect to make a required profit. And indeed, second branch here talks about working backward from the price that we believe the customer will be willing to pay and determines the maximum product costs. Now, sort of in essence there, what we're saying is a target cost is something that can be established by using a set of steps. And the steps really start with the selling price, not the cost, or not what's driving the cost or absorbing any cost, not at all. We're saying, what's a commercial selling price? What is this product, let's say, being sold at in the open market? What could we sell it at? Well, that's the selling price. Okay, given that, what's the desired margin that we want? Let's call it 25%. Okay, that's our standard margin. That's what we would like to be able to get as a return in a gross sense, i.e. gross profit margin. Let's take one from the other. In other words, let's take the margin from the selling price to get what we call the target cost. Okay, now once we have the target cost, let's compare that to what we actually believe our budgeted cost is, based on historics, based on supplier prices, based on manpower, use of manpower, etc. Now, those two things, the target cost and the budgeted cost, are going to be different. I mean, they have to be different. Well, highly likely they're going to be different. They certainly will be different in an exam question. And between those two, there is going to be a gap. There's going to be a gap. What do we need to do? We need to close that gap. We need to move from the target cost to the budgeted cost, or if you will, from the budgeted cost to the target cost. It's probably, fairly likely that the target cost is going to be lower than the budgeted cost. So we need to find ways to get towards that target cost. So you can see what I said when I said it sort of turns costing on its head. It does in one sense, because the starting point is really, well, we want to make this desired margin, therefore that's our target cost. Why are we not there? It's $2 out. Well, maybe we need to change suppliers. Maybe we need to make the production process more efficient. What do we need to do? Etc., etc. So really what target costing does is it provides the gap, and it says, what are you going to do about the gap? Find ways to get towards your target cost. That's really it in a nutshell. Okay, next area here, life cycle costing. Again, this is quite interesting. What do we mean? Well, we mean a costing approach in one sense that sort of takes into account all costs that are incurred during the life of a product. Now, I'm talking about literally from R&D, from development through to decline. We know, broadly speaking, if you know a little bit about marketing, we know that we have something that is referred to as a product life cycle. Okay, now this is, I note, and you'll note, this is simplifying things. I mean, products work in different ways. Do all products decline? Well, in one sense they do. In another sense you would think, well, no, they don't. Now, so let's take it to some extent with a pinch of salt. We're saying that a given product, broadly speaking, in general, has 5 main parts to its life: development, introduction, growth, maturity, and indeed decline. Okay, and what we're saying on top of that is that in each of those stages, in each of those areas of its life, cash flow, profitability, revenue, etc., is going to be slightly different. okay? And indeed, in particular, the incurrence of costs is going to be different. So if you look at the sort of left-hand side of the y-axis, which is obviously money, and indeed the time or x-axis, what you'll see is that in terms of input of costs or incurring costs, you'll see this circle down at the bottom, the bottom of the sort of cash flow line, as it were, at the development stage and certainly the introduction stage. It may well be that we are incurring significant costs, R&D, setup, marketing, etc., etc. So what we're talking about here with life cycle costing is let's calculate exactly. I mean, we would anyway, but what we're talking about is specific to this product. We'd be calculating our R&D costs overall as an organization, putting them into our profit and loss account, etc. But we're saying for this product, let's get a firm fix on its life costs, okay? And in addition to that, as you see, as we flow through from point number 1, development, all the way through to point number 5, you can see the relationship between sales and indeed profit and indeed cash flow. And that obviously is linked to the whole area of costs. Now, if we look slightly across the page, if I can do, I hope I can. Yes, I can. You'll see that I've cut and pasted this image out. Now, quite a lot of detail here over and above what we need, I think, but certainly it sort of augments what I've just said. If we pick a few areas out, let's look at the development area. Well, clearly we're talking about R&D. We're talking about design, development, prototypes, etc. And in terms of cash flow, clearly it's going to be negative and highly unlikely to be any revenue at all at that stage. Let's drop down a little bit, say, to maturity, okay? So at this sort of stage, broadly speaking, and again in general, demand is sort of leveling out, isn't it? Growth sort of slows down. And, it may well be that we're still making a profit, but certainly the writing is on the wall. And it may well be that we need to input in terms of more costs at this stage, possibly to change the product, to add new features, to update, to maybe be in line with perhaps competitors' products. Okay? And then last area of decline, we're talking about final stage of life. Okay? So fewer people want to buy, profit is going down, losses. Really, this is the end, as it were. So in essence, what we're saying in terms of life cycle costing, or all that we're saying, it's not complicated at all, not like, say, some areas of perhaps marginal costing, etc. We're simply saying account, record all costs and get a fix on what exactly it's costing you in each stage of the product. So it's more of a general sort of costing approach, isn't it? With regard to the general stages in the life cycle, rather than specific, per unit, etc. Okay, so that really concludes a very, very short chapter for us. As I said, I think this is a good little chapter. Is it an extremely high priority for us? Maybe not as high priority as the chapter on absorption and indeed marginal costing, i.e. the traditional methods. I'd expect much more questions on those, particularly computational questions. Let's make sure that we can do the calculations for sure. But this chapter, not high priority in terms of our time, but certainly it's an area that I don't think that we should be getting questions wrong here on this chapter, because I think it's very, very straightforward. So again, I'd probably call it one of my go-to chapters. I may allow myself to get questions wrong on absorption costing because maybe I'm not 100% on it, but I'm not going to allow myself to get questions wrong on alternative costing methods, whether it's target or life cycle, ABC, etc. Okay, thanks for listening. I hope the studies are going well. Keep at it. Cheers.